Hello and welcome back. In this video we will discuss the different types of risk, the main types of risk that exist and how to calculate expected returns. Risk is a key concept in everyday life and, more specifically for this course, in corporate finance, where it affects investment decisions and the discount rate used to evaluate them. At first, you might think about risk solely as a negative thing. This is common, since in everyday life the word risk is usually associated with bad outcomes. The risk of getting your car crashed, falling on icy roads, and so on. In finance, though, the definition of risk is both different and broader. In fact, risk refers to the likelihood that we will receive a return on an investment that is different from the return we expected to make. Risk in finance terms includes both bad outcomes and good outcomes. Bad outcomes entail returns lower than expected, while good ones entail returns higher than expected. For instance, suppose that today you buy one stock of Apple at $170, and you expect that in a month the stock can reach $180. The financial risk associated with this investment decision includes the possibility that the stock will be either less or more than $180 in a month's time. Risk, as we define it, can be divided in two macro categories: systematic risk and unsystematic risk. Systematic risk, also known as market risk, refers to the risks affecting the entire economy or a very large part of it. Such risk can be of political nature, wars, elections, as well as macroeconomic nature, inflation, recessions. For example, the Russian invasion of Ukraine and its effect on natural gas prices is a systematic risk directly affecting the world's economy, and especially the European one. The recent interest rate increases introduced by the major central banks to fight inflation is a macroeconomic risk. Systematic risk cannot be diversified away. Everyone faces it. On the other hand, unsystematic risk, also known as specific risk, affects only a particular segment of the economy or even a particular set of companies. Such risk can affect a specific investment in a company due to management changes, product recalls, regulatory changes, disruptive technologies, and new competitors. Take, for example, Nokia, the Finnish cell phone producer. Up until 2011, Nokia was one of the major producers of mobile phones in the world, generating $53 billion in sales. Starting from 2012, with the first smartphones coming to the market, Nokia saw its sales fall. In 2015, Nokia totaled only $14 billion in sales, a negative growth of 28% relative to 2011. Disruptive technology and bad forecasting product development from the management were specific risks that affected Nokia and part of the cell phone industry. Now that we have introduced the key differences between systematic and unsystematic risk, we can dig deeper by discussing other types of specific risks that need to be considered in making investment decisions. Sometimes a specific risk can become systemic. This type of risk is called systemic risk or contagion risk and refers to the possibility that an event at a company or industry level triggers severe instability or even collapses an entire industry or economy. The financial crisis of 2008 is a perfect example of such risk. Also known as the subprime crisis, it started from the banking industry and it heavily impacted the entire global real economy. The 2008 financial crisis began in the US, where cheap credit and loose lending standards from the retail banks fueled a housing bubble. When the bubble burst, by the end of 2007, the banks were left holding billions of dollars of worthless investments in subprime mortgages, meaning mortgages lent to people with low income and or no guarantees. Banks suffered heavy losses and had to be bailed out by governments, credit lending crunch affecting real businesses. Please keep in mind that systematic risk is different from systemic risk. Systematic risk is a risk that by nature affects the entire economy, while systemic risk starts in a single point and spreads out, contagion other parts of the economy. Another specific risk to consider is business risk, which refers to whether a company will be able to make sufficient sales to cover its operational expenses and realize a profit. This type of risk is influenced by both internal and external factors such as management stability, company's reputation, cost of materials and goods, industry concentration, and customers' demand. One type of business risk is operational risk, indicating the risk that arises from the day-to-day operations of a company and includes risk associated with employees, human error, frauds, violation of internal rules and procedures, systems, hardware, software failures, computer hacking, viruses, and inadequate processes and procedures. One example of operational risk is the Facebook's severe crash of October 2022, when the company suffered a major failure of its servers, resulting in users not being able to log in for many hours in a row and accounts being lost. Moving on, we can identify risks connected to the liquidity and the solidity of companies. The two major risks of such nature are credit and liquidity risk. Credit risk refers to the possibility that the borrower will fail to meet its obligations. This risk is not limited to the possibility of a counterpart default. Even a mere deterioration in creditworthiness constitutes a manifestation of such risk. Generally speaking, government bonds are usually less risky, while corporate bonds tend to have the highest amount of default or deterioration risk. This is because government bonds are backed by the government budgets, while a company's bond depends on the liquidity and solvency of the issuer alone. Take Evergrande, one of the biggest Chinese real estate developers, with 300 billion of bonds outstanding. In December 2021, the company was not able to pay interest on a tranche of its bonds. The credit agencies downgraded its rating to restricted default, a less severe form of default that did not result in a bankruptcy procedure, but still a default nonetheless. Liquidity risk refers to the risk that a company will not be able to meet efficiently both expected and unexpected current and future cash flows and collateral needs. Thus, liquidity risk is correlated to the inability to convert assets into cash in time. Liquidity risk is greatest for banks. Think, for example, at what happened in 2023 with Silicon Valley Bank. Due to bad investment decisions and the mismatch between the liquidity of its assets and the maturity of its liabilities, the bank suffered a run on deposits from its clients. Silicon Valley Bank was not able to liquidate the depositors and ultimately went into a bankruptcy procedure by March 2023. The concept of financial risk is strictly tied to the difference between actual and expected returns. Thus, it is important to understand how to calculate expected returns the right way. The formula is reported in the example. Expected returns can be thought as the weighted average of all possible returns, where the weights are the probabilities of each outcome indeed happening. To better understand this concept, let's go through a simple but powerful example. Suppose you buy €100 of a company's stock. You estimate that there is an equal chance that at the end of every year the stock will be worth 90, 110 or 130. Therefore, the possible returns could be minus 10, plus 10 or plus 30%. To keep things simple, suppose that there are no dividend payments. Given this information, the expected return equals 10%. That is the weighted average of each of the three possible returns according to their probabilities. We'll see in the next steps how to compute formally expected returns.